So, where does this leave us? If the banks have become fortresses, if the algorithms are designed to reject us, and if the investors are buying everything in sight, what happens to the concept of homeownership itself? We are standing on the precipice of a fundamental redefinition of the American dream. For generations, owning a home was the finish line. It was the symbol that you had made it. But in 2026, that finish line is being moved. Homeownership is no longer a milestone for the middle class. It is becoming a luxury good for the wealthy. This is the final piece of the puzzle. The redefinition of who qualifies. The banks have made their decision. They have decided that lending to normal people is too risky, too labor-intensive, and too unprofitable compared to the efficiency of lending to institutions. They have created a feedback loop where the lack of credit makes houses more attainable for the rich, which drives up prices, which makes houses even more unattainable for the middle class, which justifies the banks' initial risk assessment. It is a self-fulfilling prophecy. But understanding this reality isn't just about despair. It is about adaptation. For those still hoping to buy a home, the rules of the game have changed. You can no longer walk into a bank with a good job and a good credit score and expect a yes. You must play the algorithm's game. This means thinking like an institution. It means cleaning up your financial footprint with surgical precision. It means keeping cash reserves so high that they look excessive. It means reducing your debt-to-income ratio to a level that feels absurdly conservative. You have to become boring to the algorithm. No wild fluctuations, no risky spending, just a steady, monotonous stream of deposits and payments. Furthermore, we may see a rise in alternative financing. If the big banks abandon the middle class, community banks, credit unions, and even seller financing may make a comeback. The future of home ownership for normal people may lie in bypassing the monolithic lenders entirely and returning to more local relationship-based lending. It means building a financial profile that isn't just a number, but a story that a local banker can see and believe in. The disappearance of bank loans for normal people is not a glitch in the matrix. It is the matrix upgrading itself. It is a deliberate restructuring of the market to prioritize capital over community. But the desire for a place to call home, to paint the walls your favorite color, to plant a garden you know you'll harvest next year, that desire hasn't changed. The path to achieving it has just become narrower, darker, and more treacherous. It requires us to be more vigilant, more strategic, and more resilient than ever before. The banks may have closed the door, but the windows aren't all locked yet. We just have to learn a new way to climb through. There are signs of hope flickering in the margins of this bleak landscape. Across the country, small groups of prospective buyers are forming co-investment pools, banding together to purchase properties collectively in a way that mimics the institutional investors they are competing against. They are pooling their down payments, sharing the risk, and approaching lenders with a balance sheet that looks more corporate than individual. This is a workaround, a hack for a broken system, but it is a testament to the resilience of the human spirit when faced with institutional barriers. Others are turning to lease-to-own arrangements, negotiating directly with sellers who are tired of dealing with faceless corporations and would rather see their family home go to a real family. These arrangements are fraught with risk and require careful legal navigation, but they represent a crack in the wall of institutional dominance. The truth is that the banks, for all their power and all their algorithms, cannot extinguish the fundamental human need for roots. We are not datasets. We are people who crave stability, who want to paint walls and plant gardens and watch our children grow up in the same room where we brought them home from the hospital. The banks see risk in that desire. We see meaning. The coming years will be a battle between the cold efficiency of capital and the warm persistence of human hope. And while the banks have the money and the algorithms, we have something they cannot quantify. We have the will to find a way home. The 2026 housing crisis is not the end of the story. It is just the closing of one chapter and the beginning of another. One where we must write the rules ourselves. We must become our own lenders, our own advocates, our own community builders. We must look to each other instead of looking to the banks. Perhaps the death of easy credit will force a rebirth of true community, where neighbors help neighbors buy homes, where local credit unions thrive, where the relationship matters more than the risk score. It will not be easy, and it will not be fast, but it is the only path forward. The banks have abandoned us, so we must abandon the banks. We must build a new system from the ruble of the old one, a system that sees us not as risk vectors, but as human beings with dreams worth investing in. The door may be closing on the old way, but a window is opening on a new one, and through that window, we can see a future where home is not just a place you live, but a place you fought for together. If the first two sections were about the why, this section is about the how. How are banks executing this mass rejection with such cold efficiency? The answer is staring back at you from your smartphone screen. Automated AI lenders are replacing human loan officers, and with their arrival, the last shred of human nuance has been erased from the mortgage process. Remember the loan officer? That person in the slightly too tight suit who would ask about your plans for the house? Who would look you in the eye and shake your hand? They are becoming extinct. In their place is a digital portal, a faceless interface that doesn't care about your story. This is the rise of digital lending protocols. These are not simply online applications. They are sophisticated AI underwriters that can scan a decade of your financial history in milliseconds. They pull data from your bank accounts, your credit cards, your Venmo transactions. They see where you buy your coffee, how much you spend on Uber, and whether you paid your credit card bill at 8 a.m. or 8:01 a.m. These digital platforms prioritize speed and data points that favor asset-heavy applicants. If you have a lot of cash sitting still, the algorithm loves you. If you have cash moving spent on living, on diapers, on gas, the algorithm sees chaos. The human loan officer could be persuaded. You could explain that you took a freelance job for 6 months that hurt your steady income but paid off a debt. You could explain that you co-signed a loan for your sister that she has paid flawlessly for 5 years. The human could look at the totality of your life and see a pattern of responsibility. The AI sees only the data. It sees a gap in employment. It sees a fluctuation in cash reserves. And it flags you. These systems are trained on perfect data. And humans are not perfect. Perhaps the most invasive aspect of these digital protocols is real-time financial monitoring. Gone are the days when you got a mortgage and simply made your monthly payment. Now, lenders are experimenting with systems that can adjust interest rates based on daily cash flow changes. Imagine a world where your mortgage payment could go up because you had a slow month at work and your bank balance dipped below a certain threshold. The algorithm, seeing the risk, automatically adjusts your rate to compensate. This is financial surveillance repackaged as risk management. It creates a world where stability is punished, and any deviation from the median is viewed as a potential default. By removing the human, the banks have removed mercy, understanding, and context. They have built a system where you are not a borrower asking for help. You are a dataset applying for a merger, and most datasets don't make the cut. The technology behind these digital protocols is advancing at a breakneck pace. In 2026, we are seeing the widespread adoption of underwriting algorithms that incorporate alternative data sources that were unthinkable just a few years ago. Some lenders are now looking at your social media activity to gauge your lifestyle stability. Others are analyzing your Amazon purchase history to see if you are at risk but a responsible spender. The line between financial assessment and personal surveillance is blurring to the point of invisibility. If you post a picture of a vacation, the algorithm might flag you as a risk for overspending. If you have a gap in your LinkedIn history, it might assume you were fired. There is no appeals process for an algorithm's judgment. There is no manager you can speak to who can override the system. The decision is final, instantaneous, and utterly devoid of compassion. This creates a perverse incentive for borrowers to hide their humanity. To get a loan in 2026, you must present a version of yourself that is so sanitized, so boring, so predictable that you barely resemble a real person. You must scrub your financial life of any spontaneity, any generosity, any unexpected expense. You must become a robot to convince a robot that you are worthy of a loan. The irony is that the very qualities that make a good neighbor, generosity, spontaneity, community involvement, are the qualities that the algorithm flags as risky. The system is not just rejecting applications, it is rejecting the human spirit. And as these digital protocols become the standard across the industry, the possibility of appealing to a lender's better nature disappears entirely. We are entering an era where the path to homeownership is gated by machines that have never known the feeling of walking through a front door and thinking, "I'm home." Consider the case of a teacher, a veteran, or a nurse. These are professions that are the backbone of any community, yet they are increasingly being flagged by algorithms as risky. A teacher's salary is modest, and their spending habits are modest. But to an algorithm looking for large cash reserves and minimal transactions, a teacher looks like a poor candidate. A veteran might have gaps in employment history due to service, which the algorithm reads as instability. A nurse works shift work, and their income might fluctuate with overtime. Another red flag. These are the people we trust with our children, our freedom, and our lives. But the algorithm does not trust them with a mortgage. The digital lending protocol cannot measure character, cannot gauge integrity, cannot sense the quiet determination of someone who has served their country or healed the sick. It sees only numbers. And the numbers, in their cold, hard logic, say no. This is the tragedy of the rise of digital lending protocols. They are efficient, but they are not wise. They are fast, but they are not fair. And in their ascent, they are leaving behind the very people who make a community worth living in. To understand why the banks have stopped answering your calls, you have to understand a simple, brutal truth of economics. It is not personal. It is mathematical. And in the math of 2026, you, the first-time homebuyer, have become a subtraction. Problem. Banks are now prioritizing high-net-worth individuals and corporate investors over you, not out of malice, but because the new risk models have identified your income as volatile. Your job, that steady 9-to-5 you've held for a decade, is now viewed through a lens that predicts layoffs, gig economy disruption, and wage stagnation. Your paycheck, once a symbol of reliability, is now seen as a fragile thread. This is the era of shifting risk models. For the past 50 years, the mortgage industry ran on a simple premise. If you paid your bills and stayed employed, you were a safe bet. But the new algorithmic models calculate long-term risk based on employment volatility rather than just credit score. They scan the job market. They analyze industry trends, and they see that the average worker changes jobs more often, that industries are disrupted overnight by AI, and that wages aren't keeping up with inflation. To the algorithm, you aren't a person with a family. You are a risk vector, and that vector is pointing toward instability. Meanwhile, across town, a real estate investment trust is applying for the same loan on 10 different properties. They have no pulse, no sick days, no need for a maternity leave. They are a corporate entity with a balance sheet that looks like a fortress. The bank sees them and smiles. The cost of acquiring a mortgage, the interest rate, the points, the fees, has increased for individuals while staying low for institutional buyers. It's a turd system where the rich get richer financing, and the middle class gets priced out by the very capital that is supposed to help them build wealth. This institutional preference is reshaping neighborhoods. When banks favor the investor over the family, they aren't just approving loans, they are dictating the social fabric of our cities. Investors buy homes to rent, not to route. They don't care about the school district because they don't have kids. They don't care about the local community center because they don't attend meetings. They care about cash flow by prioritizing these buyers. Banks are systematically transforming home ownership from a personal asset into a corporate commodity. The risk models have decided that a diversified portfolio of rental income is safer than a single family's promise to pay. And in that cold, hard calculation, the dream of owning a home is being replaced by the reality of renting it. From a faceless corporation, the bank isn't being cruel. It's just being smart. According to a new definition of smart that leaves normal people standing on the sidewalk, watching the for sale signs go up and the sold signs go straight to investors. The numbers behind this shift are telling a story that is hard to ignore. In the first quarter of 2026, institutional investors accounted for nearly 30% of all home purchases in major metropolitan areas, a figure that has more than doubled in the last 5 years. These aren't small-time landlords buying a duplex. These are hedge funds and private equity firms deploying billions of dollars in capital. They come with cash offers, no contingencies, and the ability to close in days rather than weeks. A family with a mortgage pre-approval, even a good one, looks slow and uncertain in comparison. The banks, watching this trend, have adjusted their models to reflect the reality that the surest bet is the one backed by a mountain of cash. They have begun offering preferential rates and terms to these institutional buyers, creating a feedback loop that further their advantage. 4. The middle-income family. This means that even if you find a house you can afford, you are now bidding against an entity that can afford to lose money on the deal. Just to acquire the asset, it is a game of financial chicken that the family will almost always lose. The human cost of this shift is measured in broken leases and nomadic childhoods. Children who grow up in homes owned by corporations are more likely to move, less likely to have stable friend groups, and more likely to experience the disruption of non-renewed leases and rent increases. The community fabric that is woven by generations of homeowners, the block parties, the neighborhood watch, the familiar faces is being replaced by a transient population of renters who have no long-term stake in the property. The banks, in their pursuit of the perfect risk-adjusted return, are unwittingly architects of a less stable, less connected society. They are trading the messy, beautiful reality of human neighborhoods for the clean, predictable returns of corporate balance sheets. And the tragedy is that they will never have to live in the world they are creating. We must also consider the psychological impact of this institutional preference. When you are constantly outbid by a corporation, when you see the same investment group's name appear on every sale, you begin to feel powerless. You begin to believe that the system is not just difficult, but actually designed against you. And in 2026, that belief is not paranoia. It is accurate perception. The system is designed to favor capital over labor, to favor the entity over the individual. This breeds a cynicism that erodes the very foundations of civic participation. Why vote in a local election if the local landlords are all corporations based in another state? Why attend a town hall meeting if the decision-makers are algorithms in a distant data center? The shift in lending is not just an economic phenomenon, it is a political and social one. It the middle class not just from property, but from the process of community building. It turns citizens into tenants. And tenants, historically, have less power than owners, than banks. By choosing the institution over the individual, are slowly but surely dismantling the idea of the homeowner as the basic unit of a stable society. They are replacing it with a model of temporary occupancy, where your home is just another line item on a corporate spreadsheet, and when your home is just a line item, your voice becomes just background noise. There is a specific kind of silence that fills a room. When a dream dies, it's the quiet after the realtor's phone buzzes with an email. The pause before they clear their throat and say, the seller went with another offer. But in 2026, that silence isn't just coming from the seller's side. It's emanating from the banks themselves. Right now, over 70% of mortgage applications for middle-income families are being instantly rejected by major lenders. Let that number sink in for a moment. 7 out of 10 families earning a median wage are being turned away, not because they have bad credit, but because the definition of acceptable has shifted so dramatically that stability now looks like a liability. This isn't a temporary market fluctuation, a blip on the radar caused by a slight economic downturn. To call it a fluctuation implies that it will fluctuate back. To understand what is happening in 2026, you have to stop looking at the housing market as a place to live and start looking at it as a vault. And banks, the gatekeepers of the keys, have changed the lock. Mortgage approval rates for median income households have dropped to historic lows this month, lower than the 2008 crash, lower than the COVID panic. But where past crises were born of reckless lending, this freeze is born of surgical precision. Banks are quietly transitioning from traditional risk assessment where a human looked at your job history, your debt, and your potential to algorithmic debt-to-income screening that views the human element as noise rather than signal. These new systems aren't interested in your explanation for that one late payment 3 years ago when you were sick. They are interested in data points. And the data points are painting a grim picture. The average person, with their fluctuating income, their car payments, and their student loans, is simply too expensive to service. Think of the mortgage market as a garden. For decades, banks planted a little bit of everything. Some golfungsent golfweeball, high risk, higher reward seeds, and plenty of sturdy, slow-growing vegetables that represented the middle class. It was a mixed ecosystem. But in 2026, the gardeners have decided they only want orchids. They are pulling out the tomatoes and the carrots because they require too much water, too much care, and they don't bloom as brightly. The Great Credit Freeze is not a malfunction of the system. It is the system optimizing itself for a specific outcome: scarcity. By reducing the flow of credit to normal people, they reduce the number of buyers. Fewer buyers mean less competition at the top of the market, but it also means that those who do get loans, the wealthy, the investors, can move with speed and certainty that the average family simply cannot match. We are witnessing the death of the casual homebuyer, replaced by a transactional environment where you aren't judged by your character, but by your liquidity. The statistics are staggering when you dig into the fine print of the 2026 lending landscape. Major financial institutions have quietly revised their internal lending quotas, shifting targets away from consumer mortgages and toward commercial and investment properties. This means that even when a middle-income family meets the published criteria, they are often competing for a shrinking pool of approved loans. The banks are not in the business of taking chances anymore. They are in the business of guaranteed returns. The middle class, by its very nature, represents a spread of risk that includes both reward and failure. In the current climate, failure is not an option the banks are willing to entertain. They would rather lend to one investor buying 10 homes than 10 families buying 1 home each, because the administrative cost of managing 10 families is 10 times higher. It is a cruel economy of scale that treats human dreams as overhead. The rejection letters landing in mailboxes across the country are not just pieces of paper. They are the opening notes of a requiem for the traditional path to property ownership. Parents who bought their first homes in the 90s and early 2000s look at their children with confusion, unable to comprehend why the same steps no longer lead to the same results. The answer lies in the fact that the staircase has been removed. The banks have pulled up the ladder. and they are now only offering elevator access to those who are already on the top floor. This is great credit freeze of 2026, and it is only the beginning of a long, cold winter for the average American dreamer. We are watching a paradigm shift occur in real time, where the very institutions built on the back of middle-class deposits are now turning their backs on the depositors. The money that funds these mortgages comes from the savings accounts of the very people being rejected. It is a profound betrayal of the social contract that once existed between a bank and its community. The community bank that knew your father and grandfather is being replaced by a national algorithm that knows only your transaction history. And in that transition, something essential has been lost. The belief that if you work hard and play by the rules, you will be rewarded. The rules have changed, and the reward has been moved to a shelf you cannot reach. The silence in that room where a dream dies is now being heard in millions of homes across the nation, a collective gasp of realization that the game was rigged from the start.